Hey, how are ya? I want to talk to you guys about fees and interest. So right here we got fees. Now fees, they're basically an immediate cost. Interest, we went over that, and that's a time-based cost. So say if we had a 1% interest on $100 of principal, going back to our previous video, 1% interest on $100 would be $1 over the course of a year. So a fee of 1% would be immediately upfront paying $1 versus having to wait a year, right? So let us do an analogy for this. So basically, we're going to go on a little journey. We're going to go drive our little car here. And path A, on path A, we're going to pay a $5 toll to get directly to the destination. So we take the car, pay a $5 toll, and then we get to our destination, right? But path B, we end up paying $1 per hour at a parking garage. At the parking garage, we get a free charter bus to the destination. So which one would cost us more money? Well, it depends, right? So if we're going to be parking at the parking garage for, say, 6 hours, that's going to be $6. It's a time-based cost, right, per hour. And then versus $5 toll, the $5 is less than 6, so that would be $5 toll would be cheaper if we spend 6 hours in the garage. But if we only spent 3 hours in the garage, that'd be $3, which is less than, of course, the $5 toll. So it really depends on what you're trying to do in terms of if you got to choose between paying fees or paying interest. Now, sometimes it's not a this or that scenario. You might just have, say, student loans, right? And you have monthly payments, and let's say you miss a payment, and then you have to pay a late fee. So then they charge you some extra money on top of, just right then and there, on top of the interest. So it's not time-based other than the fact that you didn't pay on time. Now, something also to throw in there is that oftentimes if you sign up for autopay with different student loan lenders, so that way you don't miss payments, you'll actually get a reduction in your interest of about 0.25% as the time of this video. But of course, if you don't have enough money in the checking account, you can still pay an overdraft fee or something like that. So you want to make sure you obviously got the money in your account. You set that up. Now, going back again, fees, immediate cost, interest, time-based costs, right? We got our scenario where we got an immediate cost right at the toll versus a time-based cost, how much time you spend in the parking garage, right? So sometimes it's not always a real straightforward thing when you got different options in front of you. So let's say we got a loan. We got loan A, 5% fee, but no interest. And it's on a $5,000 loan. So 0.05 times 5,000, that's how we get the upfront fee, right? The 5% fee of $250, a $5,000 loan. So loan A, 5% fee, no interest. Now we got loan B. Loan B is 12% interest. So 0.12 times 5,000, we get $600 interest per year. We got a little asterisk saying the asterisk here is with no principal payments. So 12% on 5,000 is $600, and that's not accounting for any type of principal payments. We're keeping it simple right now. So, which loan would cost you more? Well, depends. Just like when we talked about here, depends how long you spend at the parking garage versus paying the toll. It's going to be a similar issue here with these loans. So let's say loan B, 12% interest, you pay it off in 4 months instead of waiting the whole year. Well, this 12% is time-based. So 4 months is both months, right? And that's what that 12% interest based off of. So over the course of 4 months, paying interest, no principal payments till the month 4, you pay it all off, you'd be paying only $200 in interest, right? Because 1/3 of 12%, 4 months is only a third of the year. That would be $200 because a third of $600 is $200. And $200 is less than $250. Now, let's say you pay off loan A right after the first year, and if you were to take loan B, it would take you a year. Well, $600 in interest is obviously more than a $250 upfront fee. So you really got to weigh the different options and so forth when you're looking at different types of debt products. Now, if you don't like four-letter words like loan or debt, we can talk about a different type of banking product. So, here. We got different types of checking accounts. So, going along back with our fees and interest, right? We got our red fees and our blue interest. We are going to look at fees and interest from a different perspective. Instead of them working against you and being costs for you, we're going to look at them actually being a benefit to you. How would I mean that? Okay, so let's say we got two different checking accounts. We got checking account A, no interest, right? You don't accrue any interest sticking your money in the account. But when you use the debit card connected to this account, you get 1% cash back on all debit card purchases. So let's say you buy a $1 candy bar with the debit card, you get a penny in cash back from that $1. 1% of $1 is 1 penny, right? Now we got checking account B. Now checking account B, you get 4% interest on all the money in your checking account, but you get no cash back on debit card purchases. So let's say it's one of those reward checking accounts. You gotta swipe the card 15 times or minimum a month or whatever, and you get the 4% rate on a certain amount on your money in the account. But we'll keep it simple and just say, let's say you have $2,000 in your checking account, okay? And you are going to keep $2,000 in the account every month. Money comes in, money comes out. You're gonna keep it on average $2,000 in the checking account. Now, 4% of 2,000, what was that, 80 bucks here? So you end up with 80 bucks over a year doing 4% interest on that. Well, that sounds good. But let's say your spending is over the course of a year, $10,000. That's how much you spend. So if you spend $10,000 on a debit card, 1% of 10,000, you get 100 bucks. But you get no cash back with the 4%. So 4% of 2,000 in your checking account, it's 80 bucks versus no interest. You get no bucks. But with the spending, you get 100 bucks with the 1% on all debit card purchases versus no cash back on the debit card purchases. In such a scenario, you would actually net more money in cash back with no interest in your checking account than you would earning 4% interest in your checking account, but no cash back. Now, let's change the numbers. Let us say you got saying $10,000 in spending. So 1% on that would be 100 bucks, right? Versus no cash back, you get 0 bucks. And let's say the checking account, you also have $10,000. You just want to keep a nice big old chunk of money in that checking account, and let's say the bank will award you the 4% on the full 10 grand. So 4% of 10,000 would be 400 bucks you'd be getting for a year. Versus the $10,000 in debit card spending, you would get no cash back, But with this one, you would get $100 cash back. In that scenario, keeping a large sum of money in the checking account, earning that interest, all else being equal, versus getting the cash back on the $10,000 versus of spending each year, you would get $100 versus cash back. You would actually do better with the interest-bearing account that gives you no cash back on debit card purchases versus the one that gives you cash back on said debit card purchases. Thus, it really depends. So you can also evaluate other products in terms of thinking on interest versus fees, in terms of thinking of cash back as a reverse fee, so to speak, kind of working in your favor versus against you. And you can evaluate other types of banking products as well. Now, we can make things a little more complicated and talk about the fact that sometimes you got different types of loans that generally not going to have a 0% loan, straight up a loan, but you might have it with different credit card offers where you get a 0 APR, introductory, balance transfer, whatever like that, and versus having like a personal loan. And you could also evaluate, say, paying more points or fees on a mortgage to have a lower interest rate versus a higher interest rate but less fees up front. And you can look at all different types of things other than just debt and loans, but also other types of banking products as well to evaluate whether or not you're getting the best bang for your buck. So again, just to keep things simple to bring it back, I know I went over a bunch of stuff. You got fees, immediate cost, and then you also got interest, which is a time-based cost. So depending on what you're evaluating, they can count for you, right? You can have that 4% working for you, or you could have the cash back working for you. In different scenarios, either one could be better, depending on the scenario, of course, or depending on whether or not you're going to pay something off sooner or later on different types of debt products could also depend which product would be better for you in terms of accounting for fees and interest, right? An upfront cost versus a time-based cost. Just some things for you to kind of mull over. I hope I didn't go over too much stuff at once, but something to consider when looking at different types of banking and debt products. Thank you.